If you're listening to this, chances are you probably have the app on your phone.
Oh, absolutely.
It's where your morning run stops being just a workout and, it starts being a quest.
A quest for a local segment title?
Yeah.
Or a king of the mountain.
Well, maybe just a few extra kudos.
That's really the magic of Strava, isn't it? It's
Yeah.
become this universal social layer for pretty much every endurance sport. It somehow turned individual suffering into a shared competition.
It did. But that beautifully simple and, let's be honest, largely ad-free experience, it's about to face the very uncompromising realities of Wall Street.
That's right.
Exactly. So our mission today is a deep dive into the impending Strava IPO. And this isn't just some abstract financial chat about ticker symbols.
No, not at all.
This is about analyzing two fundamentally conflicting perspectives. First, you have the financial demands of investors looking for a staggering $3 billion valuation.
And on the other side,
The immediate, very tangible concerns of the 180 million athletes who rely on the platform every single day.
and the context here is it's immediate. Strava was last valued at $2.2 billion back in May of 2025.
Right.
Then they confidentially filed for an IPO this January, so January 2026, and they're targeting a public debut this spring.
So for a company that really thrives on community and that shared effort, the shift to satisfying quarterly earnings calls, the rules of the game are about to change forever.
Yeah.
The central conflict here is pretty simple. Will going public fuel real innovation, give us better features and development as athletes?
Or will it just prioritize profit? Just, cramming that currently pristine experience with aggressive ads and more paywalls.
Let's unpack the financial argument first.
To really get the tension here, we have to start where Wall Street always starts.
The money.
The money. This is the investor pitch, the road to justifying that very ambitious $3 billion valuation.
Okay, so hit us with the numbers. Why are institutional investors so excited about Strava right now, especially when you look at the broader tech market?
First, it's just the raw momentum. The valuation growth is, it's pretty impressive. Strava went from a $1 billion valuation in 2020 to $2.2 billion in 2025. That's a 120% jump in 5 years.
And 2025 was a huge year for them.
A fantastic year. Revenue growth was approaching 50% year over year, and there's getting close to $500 million in annual recurring revenue.
ARR. That's the magic number.
That's the predictable subscription money they can count on month after month.
Okay, approaching $500 million in recurring revenue that's a serious milestone. But let's break down that $3 billion target. Why are investors using a 5 to 6 times revenue multiple? That feels high for what most of us see as a social app.
It is high, but it's consistent with successful software-as-a-service businesses or SaaS companies.
So they're not classing it as a social network, they're classing it as a SaaS tool?
Exactly. Wall Street sees it as SaaS because the revenue comes from these sticky, repetitive subscriptions, not just, one-time sales. That 5 to 6 times multiple means for every dollar of predictable revenue Strava makes, investors are willing to pay $5 or $6 for the company itself.
It shows a ton of confidence in that subscription model.
Huge confidence.
I can see that. But the pressure is also external, right? We know this IPO is driven, at least in part, by liquidity pressure.
Oh, absolutely.
Yeah.
The early VCs, you're talking about firms like Sequoia and TCV, they've been sitting on their positions for over a decade.
They're ready to cash out.
They are ready for a clean, profitable exit. So that aggressive pricing strategy is basically necessary to make those early backers happy.
Okay. So let's look at what investors see as the competitive moat. What are the pillars holding up this $3 billion valuation?
The first and biggest pillar is what they call subscription durability. The argument is that fitness spending is historically stable. It's almost recession-resistant. The thesis is that your core users, the marathon runner, the competitive cyclist, they don't really cut their health and training spending when the economy gets tight.
Wait, hold on. I'm not sure I buy that. Isn't a premium app subscription like the definition of discretionary spending? How do they prove this is truly recession-resistant compared to, say, canceling Spotify?
They argue the commitment is just different. Once Strava is part of your routine, it feels more like a necessity, not a luxury. That brings us to the second pillar. Network effects at scale.
The community.
With over 150 million users, they've hit critical mass. Segments create local competition, Global leaderboards create aspiration. Every friend you get to join makes the platform more valuable for you.
So the stickiness isn't just convenience, it's social pressure, it's community validation, and it's that fear of missing out on all the data.
Precisely. Third, the data aggregation advantage. Strava is basically infrastructure at this point.
The central hub.
It unifies data from over 400 different devices, Garmin, Apple Watch, Wahoo, you name it. A lot of athletes see Strava as their system of record because it ties all their hardware together in one feed.
So they're kind of the Switzerland of workout data,
Yeah.
but doesn't that make them vulnerable? I mean, what if a huge player like Apple decides to just lock down its ecosystem or heavily restrict data exports?
Well, that is the primary defensive risk, and it's why the fourth pillar is so critical: market expansion.
Okay.
Their acquisitions, like Runna for AI coaching and the Breakaway for cycling analytics, show they're moving from just being a tracker to becoming a full-service coach.
Right, so they're trying to own the whole experience.
And that triples their total addressable market. It goes from the 500 million people who track workouts to the 2 billion people who actively want to improve their performance.
They're professionalizing the model.
And finally, a huge one for long-term investors: demographics. Gen Z adoption grew 40% in 2025 alone. Young subscribers mean high lifetime value. You're talking maybe 30 or 40 years of subscription revenue per user. That growth completely addresses the concern that Strava was becoming a platform for an aging niche user base.
That does paint a very powerful financial picture for Wall Street. I get it. The metrics are there to justify the valuation. But the second you attach a $3 billion price tag to the company, the only people who ultimately end up paying for it are the athletes. So let's flip the script to the athlete reality. This is where the conflict becomes very real for you listeners.
And that is the core tension of this entire deep dive. Strava now has to prove it can turn those 180 million users into predictable high-margin revenue. And the current math is genuinely startling.
So let's break down that unpaid user burden. What does the current user base actually look like?
The math is frankly unforgiving. Only about 10 to 15% of the global user base pays for premium.
Which is $80 a year.
Right.
Just think about that for a second. That means somewhere between 127 and 135 million users are generating zero revenue.
Zero. While still using up infrastructure, hosting, and data management resources.
That non-paying user base is roughly the size of a large country. Wall Street doesn't see a passionate global community there.
No, they see 130 million unmonetized data points that need to start generating X dollars per quarter immediately. Analysts are going to hammer them on this monetization gap in every single earnings call.
And if you look at the precedents, Spotify, Duolingo, LinkedIn, every single major consumer platform that goes public eventually monetizes this for users through ads. It feels, I don't know, inevitable for Strava, doesn't it?
It really does. I mean, they could try aggressive paywalling or jacking up premium prices, but those moves usually cause massive user backlash and churn.
Right.
Advertising, if you do it tastefully, is often the path of least resistance to get cash from that 85% of non-paying users.
So what might this intrusion look like in our beloved pristine activity feed? Let's get specific.
Well, it's going to be highly targeted. We can definitely anticipate sponsored segments. Imagine you hit your biggest GOM ever, and the congratulations banner says, "This segment was powered by Trek."
Oh, I tried that.
Or promoted posts for, say, a nutrition company appearing right between your friends' runs in the feed.
Or those jarring post-activity offers. You just ran 10 miles. Here's 15% off those shoes you looked at online. It undermines the achievement by commercializing it.
It makes it feel less authentic.
Yeah.
And don't forget branded challenges, where a supplement company sponsors the whole event just to get thousands of users to opt in and share their data.
So if ads are coming, what leverage do we, the athletes, have? We're a massive, engaged user base.
Yeah.
What should we be demanding?
If the community wants to put pressure on Strava, they should demand a few things. First, strict relevance.
Okay.
Demand only sports-specific advertising. Gear, nutrition, fine. But not, car insurance or pharmaceuticals.
That's critical. Second,
No data sales. Insist on transparent policies that strictly prevent them from selling your route tracking data directly to advertisers.
absolutely non-negotiable. My training history is not an ad asset to be sold to the highest bidder.
Third, affordable access. Pressure them for an affordable ad-free option, like a student rate or something, for users who just can't afford the current $80 price tag.
That prevents it from becoming a two-tiered system where only the wealthy get the real experience.
Exactly.
And let's not forget the current paying members. Premium pricing hasn't changed since 2020. Investors are going to see that not as loyalty, but as a massive missed revenue opportunity.
Oh, for sure. Expect them to scrutinize that heavily, leading to increases to maybe $99 or even $120 a year.
And new tiers.
And we anticipate new, more expensive tiered subscriptions. A pro level will appear with advanced analytics, forcing the current $80 users into the middle tier.
This widening of the feature gap is a real concern. That communal feeling could seriously erode if basic things like segment filtering disappear behind a steeper paywall.
And this brings us to the most concerning trade-off of all: privacy.
Right.
Strava handles incredibly sensitive location-based data. Your training patterns, your recovery routes, your exact speed and location at any time.
This isn't just abstract data. This is my exact route every Tuesday morning. It reveals my health habits, my vulnerabilities.
And that information is incredibly valuable, not just to gear companies, but to healthcare providers, insurance companies, researchers.
So while Strava's current policy restricts this, post-IPO pressure to find new revenue streams could lead to a quiet policy shift.
The risk of data monetization is undeniably higher in a public company. The risk isn't what they are doing now. It's what they might be forced to do later to hit their growth targets.
That is the profound, uncomfortable truth of going public. Okay, let's pivot and look externally. Beyond the internal pressures of Wall Street, what does the competitive landscape look like? Where are the real existential threats coming from?
What's fascinating here is that Strava faces pressure from three very distinct directions. You've got the platform giants, the dedicated niche experts, and the ecosystem lock-ins.
Starting with the giants, we're talking Apple Fitness Plus in LA
Right.
and the broader health tech space.
Apple is the single biggest existential threat. Apple Fitness Plus is getting more and more sophisticated. It's incorporating route mapping and segment tracking right into the iPhone ecosystem.
So for the casual user, why pay $80 a year for Strava when Apple Fitness is basically free with the phone you already own?
Exactly. That goes right after the massive non-paying casual user base that Strava desperately needs to monetize.
What about AI?
We have to watch for AI disruption. Something like a ChatGPT Health could be a real threat. Strava just bought AI coaching apps like Runna. But what if a powerful, generalized AI can just import your raw data and offer a superior, customized coaching for free?
It makes Strava's acquisitions a liability. The AI becomes the coach, and Strava is just a data bucket again.
Right. And then you have the niche competitors. They are stronger in specific areas.
Like route planning.
For serious cyclists, route planning on Ride with GPS offers, arguably superior tools. Those users prioritize utility over social validation.
And on the hardware side, you've got Garmin.
Hardware integration is dominated by Garmin Connect. Serious athletes are locked into that ecosystem. Then you've got the biometric experts.
With Aura.
Exactly. They offer deep recovery and strain metrics that Strava just can't match without its own hardware.
So if the competition is that intense, why isn't Strava more scared?
Because its strength is still being that universal social layer. Athletes use specialized tools, sure, but they all post to Strava for the community validation and the segment competition. As long as it holds that hub position, it's defensible.
Which brings us to timing. Why now? Why is spring 2026 the moment they pull the trigger on an IPO?
Three things really came together. First, market opportunity. The IPO window for profitable tech companies, it reopened in late 2025. They need to go now before potential market volatility like the 2026 U.S. midterms hits.
Okay, that makes sense. We talked about investor exits already.
Right. Investor exits. Early backers have been patient. They want their money.
And the third factor goes back to those acquisitions, Runna and the breakaway.
That's acquisition currency. Going public gives them stock, which they can use to make more strategic acquisitions without having to raise more cash and dilute their existing investors. M&A is clearly a key part of their future growth plan.
That all makes perfect sense. So let's synthesize all this.
If we tie this all together, the uncomfortable truth for you, the athlete, is that the incentives of public markets, that relentless demand for profit and growth, they often fundamentally conflict with the values that made Strava so beloved in the first place.
The authenticity, the ad-free experience. Yeah. Wall Street analysts care about revenue per user, not the spiritual purity of bagging a co-am. Yeah. So looking at everything, what's the most likely future scenario here?
I think the most likely scenario is a necessary compromise. It's going to be somewhere in the middle ground.
Meaning?
Strava will introduce advertising, thoughtfully, I think, but unavoidably, to address those 130 million unpaid users. Premium pricing will go up, probably to that $99 to $120 range.
And they'll move more features behind new paywalls?
Yes, strategically. It'll be frustrating for longtime users, but the platform will stay dominant because the core functionality tracking segments the friend feed will stay accessible enough to keep it the hub.
So it'll be successful and profitable, but maybe less universally loved.
That's a perfect way to put it. So what should you, the athlete, be watching for post-IPO? This is your essential checklist.
Okay, first, pay very close attention to the advertisement rollout. Monitor the timing, the format, and most importantly, the relevance. Is it just gear, or are they selling you insurance?
All right. Second, watch for premium pricing changes. Are they adding a new $120 Pro tier or just raising the existing plan? Look for a 20 to 50% hike.
Third, observe feature paywalling. Do essential tools like route creation or historical fitness data suddenly become exclusive to the most expensive tier?
And finally, and this is the big one, read those privacy policy updates carefully. The small print about data sharing with external entities like health or insurance providers, that's where the biggest risks are going to be hidden.
It seems really clear that the ad-free experience you currently enjoy as a free user, it has an expiration date.
It does.
So the central question for you is personal, and is what we'll leave you with today. When those inevitable ads arrive and when the price hikes hit, will you tolerate the compromises to stay with the community? Will you upgrade to the more expensive premium? Or will you migrate your data and your need for validation to a smaller, athlete-first alternative like Ride with GPS?
The clock on the purity of the platform is definitely ticking.